Hey everyone, Eric here. In this video, I'm going to talk about what is carried interest and why it's so important for venture capital and private equity funds. Then we're going to talk about the carried interest tax loophole and how it allows these funds to pay very low taxes on their returns. Okay, let's get started. Okay, so in this video, we're going to talk about two main subjects. The first is carried interest and how to calculate it. So at a very high level, carried interest represents the investment profits from a private investment fund, so that could be venture capital, private equity, or a hedge fund, that go to the managers of the fund, which are called the general partners. So we're going to walk through that calculation so that you understand exactly what that number is. The second thing we're going to talk about is the carried interest tax loophole. So this is basically a law that allows the managers of specifically private equity and venture capital funds to pay a very low tax rate on their share of the profits from the funds that they manage. So it's a pretty interesting calculation, but we need to walk through, and then I'll talk a little bit about the debate of why this is such a hot topic through really on both sides of the political spectrum. There are a lot of politicians who do not support this tax loophole and a lot of politicians that do support this tax loophole. So I'll walk through sort of why it's, what are they talking about? So first, let's talk about carried interest. So carried interest is, in order to understand carried interest, you need to understand first, how is a private investment fund structured? How is it funded? How are the profits shared? Who gets what fees? Who pays the taxes? So we're going to walk through this whole thing. So the structure of a private investment fund is that you have basically two main groups of people involved in the fund. You have general partners, and we call these GPs, just as an acronym, and you have limited partners. So the general partners are the fund managers. So they run the fund itself. They do all the deal sourcing, they find the companies, they hire the team, they invest the money, they sit on the boards, etc. So they're the face of the fund. But the people behind the fund are the limited partners. So the limited partners provide the capital of the fund. So they generally have no operational involvement in the fund, but they put up the money and then the general partners invest the money. And also one thing I want to say is that often once general partners become very wealthy, they start funding a lot of the capital in their own funds, but that's another conversation. So we're going to talk about a fund where you have general partners, which manage the money, and limited partners, which provide the money. So the typical fee structure of a fund, and this is the fee that the general partners charge the limited partners to invest their money, is something called a 220. And sometimes the fees go as high as 330. And so 220 basically refers to two things. Two is a fee as an annual fee on the assets under management of the entire fund. So if our fund is, say, $400 million, the GPs raise a $400 million venture fund, they ask the limited partners for a 2% fee each year. So 2% of 400 million is 8 million to fund the operations of the fund, to pay their own salaries, the rent, all their staff, etc. So this fund is basically collecting $8 million every year, the GPs from the LPs. And then you have the 20 of the 220. And this is actually the carried interest. The 20 is the carried interest. So it's the profit share. So once the initial fund has been paid back, so once the LPs recover their 400 million, any profits from the fund in excess of the 400 million, there's a profit share between the GPs and the LPs, and the GPs take 20% of all the profits, and that's called carried interest. So let's walk through an example so we can just see the basic math of sort of what that would look like for a $400 million fund. So let's say the GPs raise this fund, 400 million, the LPs put the money in. Over 5 years, they're taking 2% asset under management fee each year. So they collect 40 million as they're basically investing this fund. So let's say at the end of 5 years, and 5 years would be pretty short. Usually funds are invested in businesses for as long as 10 years or sometimes even more. But let's say that they basically get a 3x on the money they put in. So once all these businesses get acquired or they go public or whatever, the GPs go and they have 1.2 billion to return basically back to the LPs or to calculate the profit share, etc. So the fund returns 1.2 billion, put in 400, get out 1.2. So the profits of the fund are 1.2 billion minus 400 million, so 800 million. So the limited partners get back their 400 million plus 80% of the profits. So 80% of the 800 million. So they make a little over 1 billion. And then the carried interest, like I said, is 20% of the profits once the fund has been paid back. So the GPs make 160 million on this fund in addition to the fees taken over the 5 years. So carried interest is just the profit share that goes specifically to the GPs of the fund. And for this specific income just to the GPs, there is a kind of a weird tax loophole that I'm going to walk through how it's treated and how it's taxed. And it's strange, and there's been a huge political debate about it for many years as to whether this tax loophole makes sense and they should continue to be paying really low taxes, the GPs themselves, on their sort of income that they make from these funds. By the way, if you're finding this content valuable, please like this video right now and subscribe to my channel so that you don't miss any of my new videos. So now let's talk about the carried interest tax loophole and debate. And so in order to do this, we need to talk a little bit about how these types of profits are classified from a tax perspective. So the carried interest tax loophole specifically applies to private equity and venture capital, and it really doesn't affect hedge funds at all. And here's why. Private equity and venture capital funds generally hold their investments for a really long time, 5 or 10 years. And any investment that's held for more than 12 months, and I'm talking about the US, so I'm not sure what the classification is sort of around the world, but in terms of the US, here's what it is. It's considered a long-term capital gain. So there's basically a lower tax rate on if you hold an investment for a longer period of time, just to kind of incentivize long-term investing rather than like short-term trading. And so basically any money that private equity and venture capital funds make, any profits are considered long-term capital gains. But hedge funds, because they're investing in public businesses, they're getting in and out of tons of trades, they're using margin, they're investing in bonds, they're going short this, whatever, most of their positions are actually shorter. So the bulk of the income they make are from positions they've held less than 12 months. And so those are classified as short-term capital gains. And short-term capital gains are taxed more at a normal income tax rate, whereas long-term capital gains have this lower tax rate that we're going to talk about right here. So long-term capital gains are taxed currently around 20%. And as a reference point, if you're watching this in the future, it's June 2021 right now. So it could be that these numbers change. They actually usually change every couple of years anyway. But currently, long-term capital gains tax rates for people who have really high income are about 20%, whereas short-term capital gains tax rates are just the regular income tax rates. So they can be like 35 to 40%. So really different tax rate for private equity and venture versus hedge funds. And so the carried interest tax loophole is around this 20% right here. So you have basically this fund, but who actually pays the taxes of a fund? So the fund itself doesn't pay any taxes. It's basically just like a holding company where people just own shares in this shell company, and then the profits and losses are passed to the owners of the company, and the owners have to pay the taxes themselves. So the fund itself doesn't pay the taxes. It's the individual general partners, they pay the taxes as their personal income taxes, and the limited partners, they also pay the taxes as their personal income taxes. So the limited partners put their own money in, and it's invested for 5 to 10 years, and then they get their own money out, and it's legitimately a long-term capital gain because they held the investments for a very long time. And so these people paying 20% makes sense. It's the same tax rates that a regular person would pay. The debate here is around the general partners. So the general partners are taking this big share of the invested money, but the money that was invested wasn't theirs. It was the limited partner money. And so why are basically investment taxes lower than income taxes? Because the money that you have to invest, generally you already paid tax on it one time. So if I make a salary and I save up some money, I pay tax on it the first time. So when I invest it and I make money on that investment, that's already a second tax. So generally the idea is that, you pay a lower tax rate because you already paid tax on the money once. But the carried interest tax loophole allows the GPs to pay long-term capital gains taxes at 20% on their carried interest. But for the GPs, this isn't the second time they've paid taxes. It's the first time. It's not their money they invested. They took just a share of the LP's gains. So it's not a second taxation. It's the first taxation for them. And so the debate is, should they be allowed to pay this very low tax rate on something that basically isn't a long-term capital gains tax for them? So that's what the discussion is about. Should their basically carried interest be classified as investment income or wage income? So the supporters of the carried interest tax loophole say that it is investment income, that because the GPs invested this money for so long, the income is from investments, and it incentivizes management to create larger returns for the LPs. And also having lower tax rates on this sort of investment gains keeps more risk capital flowing into private companies, and that stimulates the economy. So those are sort of the supporters of it. And the non-supporters of it say that it's basically just performance-based compensation. So the better the fund does, the more the GPs get paid. And so it's like a bonus. So it should be taxed at a regular income tax rate because it's not a capital gain for the GPs, because it's the first time they're being taxed. So why would they be getting a preferential double taxation tax treatment on money that was never theirs in the first place and is just basically like a performance bonus? So obviously both of these perspectives are legitimate, and there's a lot of political debate on what's more important, to keep the capital flowing and have lower taxes, because these GPs, a lot of money they make, they just dump it back into private companies. So it does actually keep money flowing into private companies. But the non-supporters are saying, hey, someone in the middle class pays a higher tax rate than these people making, $100 million a year. That doesn't make sense. So closing the carried interest tax loophole would be specifically taxing private equity and venture capital GPs more on their personal income taxes. So kind of that's what the debate's about. All right, well, I hope you now have a really good understanding of what carried interest tax is, as well as how it's currently taxed in the United States. By the way, in the description below, you can download this Excel file for free if you want to use it for yourself. I've also linked down below to some of my other financial modeling videos. Check those out. And if you found this content valuable, please subscribe and click the little bell icon, like this video, and leave me a comment below. And also check out my online programs if you want to do more finance training with me. That's all for today. Thanks for watching, and I'll see you in the next video.